Good morning, my YouTube friends. I hope everybody's doing well. Back to doing the live. It's the first time. I know it's probably fallen out of favor because people aren't used to me doing it anymore, but at least back home, back in the office, super jet lagged. Hopefully, some people start to show up and I don't just ramble about like a typical video with no ability to ed up. So, all of my screw ups will be on there. But I figured either way, I was a little bit prepared that that might happen since I went away for 3 weeks and I had only started doing a few lives. So, one of the things that I just wanted to start rambling about while I wait for people to show up, and then I actually pulled up Target and I'll probably pull up a couple others and look a bit at the financials and go over that as well. But I had a long conversation with my brother yesterday, and I really think the market is actually priced properly, despite all the analysts talking about how overvalued it is. And I'm going to explain why I think that. So I hope that everybody understands because it made a lot of sense. Because when I'm looking at the pricing of the market, what I've noticed is when you look at the big, boring, old traditional companies like, you know, well, Kimberly Clark, but for obvious reasons, with what's going on with Kenvue, they've been a little bit off. But let's talk about my favorite one, Target or Conagra or some of the others that look rather inexpensive to me. And then you mirror them with the Teslas and maybe Palantir and some of the ones that to me look extremely overvalued. And the reason that we think that they're overvalued is when you add into them hi Lily, the 2x, 3x, and 5x ETFs that have come out on individual stocks. So let me explain the thought process. And anybody else, like I got my iced coffee this morning. Like I said, I'm a little jet lagged, so if you see me stopping and taking a pause to drink, I apologize, but it's going to happen from time to time because I got a weird morning going. The interesting thing, what's kind of funny about the jet lag, is it doesn't even make sense to what the time difference was where I was. I'm just like my clock is just off. I'm noticing when I'm like falling asleep or waking up or whatever, it doesn't coincide with the timeline of where we were. It's just totally random. So my brain is mush. So I apologize if I ramble a bit. So either way, let me explain my thought process as to why it makes sense that the Teslas of the world are overpriced. And look, right off the bat, I think Tesla is so overvalued right now. When I looked at it, it's 250 times forward earnings. And I think a reasonable thank you. Well, I appreciate the kind welcome back, Mr. Somebody. Sorry, not Mrs. Umbuddy. It's Mr. Somebody. Um, 250 times forward earnings is, to me, absolutely absurd for Tesla. Even if you want to give it an 100 PE, which I still think is absurd, you're still talking a massive pullback that should be in half that probably doesn't happen unless we have a massive recession. I think wherever things are priced or where they're priced, and they'll probably continue however they continue for whatever reason. But let me go into why I think the overvaluation on some of these things makes sense when you take into consideration all the individual ETFs on the individual stocks for the 2x, 3x, and 5x. So let's go with my analysis on Tesla and say realistically, maybe it should have a 60 PE, which is aggressive, but if you want to be paying extra for robo taxis and robots and all the other stuff, I understand maybe a 30 or 20 PE is not realistic. Add into the equation, though, the 2x ETFs that they have out, the 3x ETFs they have out, and I think Tesla may even have a 5x ETF. So if people are investing $10,000 to make the math easy on a 2x ETF of Tesla, well, for every 10,000 they're putting in, the ETF has to buy the equivalent, whether they're using options or buying the stock outright, of $20,000 worth of the stock. So if you have those over aggressive ETFs that are using the 2x multipliers and they have to buy additional stock, well, that's going to drive the PE higher than where it should be. Do you understand why? Because if Tesla would naturally trade where it would trade, and you put in a 2x ETF that people start buying because they want double the return or double the loss potentially, well, all of a sudden you have all of that money now pushing in to buy Tesla shares. That's going to impact its PE and make it expand and be a little bit exaggerated for where it should be. So when the analysts are scratching their head, confused about the PEs are overvalued and it doesn't make sense, the reality is, if you think about it through, it does make sense. And not only does it make sense, it probably continues that way going forward. And it probably has really big up and down swings because of those ETFs. Um, so let me, good morning, LaFois. What's your dry powder and percentage of your portfolio? So Mr. Somebody's asking me, what's my dry powder and percentage of your portfolio? I've been holding more cash than usual in anticipated buying opportunities. So let me say good morning to Rudolph first, because I'm going to ramble about that for a little bit, just about me specifically and what I tend to do. I am still alive, Rudolph. Thank you for wishing me the best. We were actually out of the country for a little while, and maybe we'll have time to blabber about that a bit. We went to China and Japan, and we were out away for about 3.5 weeks. But now I'm back home. I'm going to try to be doing the live every week. I'm going to be consistent with that. And if we start getting more people to sign up, I'll add additional days, because I really love the live platform. I like that I can answer questions and it's interactive. I think that stuff's super cool. And now that I've gotten more comfortable adjusting into the house, it's nice that I have the computer in front of me and I can look at some valuations, and actually, if people want me to look at specific tickers, I can pull them up. So, all right, well, cool. I'm glad. I figured you knew. So, Mr. Somebody, I keep very little dry powder on the sidelines. The reason is I am a full believer of time in the market is more important than trying to time the market. As much as I watch prices and try to time it and do trade in my trading account and everything else, I might buy on margin when I'm putting trades on, which is why I say, my little disclaimer of you shouldn't be listening to me or anybody else when making your financial decisions. And because I really mean it. Like, what I do is not what I would advise most people to do, but I was a commodities trader for a long time, and it's hard for me to get the trading out of my blood. I think the best way to invest is buy things like you buy a sneakers, and think of that money as gone, and buy great companies and just leave it alone for years. It works out. I do my trading just because of my personality and my compulsive behavior, but I keep it as a really small percentage because I know better. And the account that primarily just sits does incredibly well. And I have good companies and I'm very content. And they have ups and downs, and some are against me, and I stay with them, even though, like, I own Starbucks from significantly higher, but I still think Starbucks is a great company and have no reason to just sell it simply because they're going through a transition right now. And I understand, like, I see all the negative arguments and understand them, and it's no issue with me, but I still think they've got a great brand. If I happen to own Nike, I would feel the same way, but I don't, just for disclosure. But the reason I do that is I don't really want to time the market with a majority of my investment, and I want to be fully invested. I, again, don't always advise that for anybody, especially depending on your specific situation. And I'm not a financial advisor, for the disclosure, and reach out to your own and all the other stuff. Um, good morning. So the thing is, I don't want to have the cash on the sideline because I feel like I'm losing the investment being in the market. I don't want to wait for some big correction because, okay, it's very hard for me. No, I've not sold my Portillo's. I still own it. I don't plan to sell it. I've been more tempted to buy a little bit more because, same thing. I think they're still the same company. Just because the stock price has gone down doesn't change my analysis. I'll pull that up when I'm done rambling about the dry powder on the sideline that Mr. Somebody had asked about. But I want to be fully invested, and I don't want to wait for some big correction, because let's pretend for a moment that a big correction comes once every 10 to 15 years. Well, do I really want to be sitting on cash for 10 to 15 years waiting for the correction to deploy that cash? And it's hard for me at this given moment, because it is possible that we're overvalued and whatever else, and all the doom and gloomers like that could be realistic. So maybe somebody else wants to have cash on the sidelines. But my attitude is, if I lose 10 to 15 years of being invested while I'm waiting for a correction, well, when the correction comes around, I was probably better off just being invested and not thinking about it so much. So, like Joe even kind of said something similar about it, but based on our conversations in the chats, like I think he feels there's probably a huge correction coming in. Maybe there is. I just I think a lot of things have changed, and I know it's this time will be different and whatever else. But let's talk specifically to the housing market for a moment, because I saw a video. I watch YouTube too. I love being a absorber of content as much as I like going on and yapping. But I don't see a huge housing correction ever, unless things get totally out of control. And I think housing is overpriced. So I don't want that heard wrong or anything else. The reason I don't see one coming is I don't think the Fed or the government is going to allow it to. And I think between the great financial crisis and COVID, they have a lot of weapons in their wheelhouse at this point, that they'll just implement them one at a time to stop it, because they don't want the banks to own the properties or some big crash. So, great financial crisis, we have cutting interest rates and quantitative easing to make the monthly costs go down. So if we start to have a real correction, which would need mass job layoffs and people putting on multiple homes, not individuals, but multiple homes have to come to the market all at the same time, pushing the prices lower. So you need the unemployment and other things going on to cause that wave of inventory to come to the market. Now, I don't mean what's come recently. We have more than we used to, but you need panic. Well, you then go fast forward after we've had cutting rates and quantitative easing, and now they've learned that they'll just add to that forgiveness. So if we really ran into a terrible situation, they would allow people not to even make their mortgage payments to try to catch the market. And my guess is they would come up with something new if that didn't stop it as well. I think all of that is actually terrible, because I think markets should have ebbs and flows and booms and busts, because I think those corrections create the opportunities for future generations to be able to get in, as much as it hurts people who got overextended. But that's kind of what markets should do. I think going in as a government and stopping markets from being markets to some degree, I think having some stop loss things or some things to stop like total panic when it's not necessary potentially is not as terrible. But I think artificially doing it just to make it more smooth is a mistake, and it's not fair. Because if you're young and you didn't have an opportunity to get into real estate when it was less expensive, and now the government comes in and stops corrections from happening, it really impedes your ability to ever get a really good deal on a property from somebody who's been overextended. And unfortunately, I do think that's what the government's going to do going forward. So I really don't see a big stock market crash. I don't really see or a housing market crash. And I see that as a net negative, but I think that's a reality of just seeing what's going on. I also don't really see a huge stock market crash, because partially, I don't think it's as overvalued based on what I was saying about the 2x, 3x, and 5x ETFs either. And when I look at individual companies outside of a few, their pricing can make sense. And the ones that are a little bit overvalued, when I add into that equation all those newfangled ETFs, Maybe they'll just stay overvalued. Maybe the stock market's a little bit more of a gambling mentality than it's used to. So now, Rudolph, I did want to go back to, and let me pull up Portillo's. No, I have not sold it, nor do I plan to. I would go down with the ship. Look at that. It's at $4.65. And I think I probably bought it at, I don't know, 12 or $15. But it's in my set it and forget it account, which really is a set it and forget it account. And I didn't buy such a large position in Portillo's that I'm super concerned about it either. But they're a new restaurant, so I expect the fluctuations. Let me take a quick look here. What I do like is the market cap now is 355 million, and nothing has changed on my opinion about Portillo's. So what I yeah, I good. I'm glad you bought it under 7, which is why I've thought of adding on. The only thing is I don't want to start just plowing into it out of stubbornness either. But Portillo's is a great restaurant, and they're super busy in the Chicago market. My brother still lives out there, and I've asked him from time to time. He's in the suburbs, so there's one or two out by him, and there's always a line. The cars are backed up through the drive-through. They're always busy, and people still love them. The reason I bought Portillo's is my thought was I feel like they're a restaurant that hits a market that isn't really served, and that I think would translate if they expand throughout the country. Now, being that they're so new, they may screw things up. Maybe they have a bad group of people running it, and maybe they don't do the things that I think they should or could. I think their menu's a little too big. I think I don't know if you guys know I owned a restaurant for 10 or 11 years, and I think there's something to having a simplified menu. Ours was very large too, which makes it harder to get staff. Now, in Chicago, Portillo's does a phenomenal job and they run it really well. Maybe multiplying across the country, having such a large menu wouldn't be so easy, but the foods that they make are things that you can't find in a lot of places, and they're quite good. So to me, if they expanded and went to different states where it doesn't exist, I don't know. I moved to Las Vegas years ago. It is not easy to find a Chicago beef. And as somebody who grew up in New York and is a bit of a snob and loves New York pizza, I will tell you a Chicago hot dog that I turned my nose up to when I moved to Chicago in, boy, when did I move there? 1994. Blows away a New York hot dog. Sorry, guys. So there are things to learn about. Different areas have things that are unique to their cities that might be really good. And Portillo's does a great job of having Chicago beefs and Chicago hot dogs, and then they've got that shake that everybody loves and everything else. So nothing has changed in my view in terms of Portillo's. So I'm not going to let the stock price falling really freak me out on it. I could understand it making somebody uncomfortable, but at least on current earnings, it's showing a 13 PE, which is really reasonable. Let me look at the fundamentals and see some of the other stuff and break into the numbers. Because that answer really is just about my opinion on Portillo's. Obviously, no dividend, but they had a good PE. Their market cap is really good. They're making money, which for a new company is great. Inventory turnover looks relatively good. They're pretty efficient. Same with receivables. Like even so they give these and I use E-Trade and just go into their analytics comments and they give these little, these ratios give an indicator of efficiency, um, that they're a little bit better than their peers. So they run a decent business so far. The PE is lower than 64% of other companies in the restaurant and bar industry, and they're growing. So I don't know. I don't plan to do anything. Wow, gross margins 65. Let me see. Oh, okay. Sorry, gross margin 65%, but net profit margin is 3.7. The net profit margin is probably a little bit low. It should be better, but I don't know if food costs, as you guys and I know, have gone up a ton, and labor costs have too. So maybe it's squeezing them on the net profit margin. I'm pretty impressed that their gross margins are 65%. That's super high, but then they're spending a little too much on staff and other things, and maybe the paper goods and whatever else. Because I would like to see the profit margins closer to 8 or 10% for a restaurant, but I like that they're profitable, and I still think they really have room to grow. They may not. They may suck at what they do, and it's hard to know. But my plan with a company like Portillo's when I bought it, and it's still the same, is in 15 or 20 years, either they've become something legitimate and they've got, 500 restaurants across the country, or they just haven't. And either way, it's okay. Sorry, I fell behind. Let me see if there are other questions. Looks like you. Yeah, I've eaten there quite a bit, DJ, and a lot of other places. Something I could probably work on, but yes, I am a rather big guy, and I like my food. I'll joke that I've spent lots of time and money spent on this, so I don't want to just give it away too quickly, but that's just a joke. Um, Cheesecake Factory, I don't know. Let me see if I can find the information. I haven't looked into them. Um, I think my issue with Cheesecake Factory is that I feel like as a restaurant, they've gone downhill. When they, the first time I went to a Cheesecake Factory had to be 30 years ago, and I remember thinking how good their food was. And I can't tell you the last time I've gone because I'm always disappointed. Um, Thank you for sharing my experience. Okay, so let's take a look at the numbers here. They do pay a 2% dividend, so that's not bad. Um, there's a good amount of short interest. That's kind of interesting. Looks like they've been pretty aggressive using debt, but their earnings per share is greater than 74% of its peers, so they run a good business as opposed to the other. They run it really well. Asset turnover is much slower. They don't do a great job in moving things, which would bother me, but they still have a reasonable, I mean, they have a reasonable PE as well. It's only 15.86. And really, the only reason I've never looked into them is because of what I said, which is uh, as a as a customer, I've never been thrilled with the product, or not never, over the past few years. Um, But I guess maybe my numbers were off a little for restaurant. I mean, their net profit is a little over 4% also, as much as I say I'd like it higher. Maybe restaurants are just, I'm going to pull up McDonald's out of curiosity just to have something to compare to. Um, and decent gross profit margins, but it doesn't look as bad as I would have thought. The only reason I don't look at it is, like I said, I used to think that their products were so good, and I probably haven't been there in 3 or 4 years, and maybe once a year or so prior to that. And every time I was just rather disappointed with whatever it was I got. So let me take a look at the margins for, yeah, I mean, McDonald's has net profit margins. I know it's different because they're more of a real estate company too, but 32%, which that's incredible. But let's look at Texas Roadhouse. Sorry, out of curiosity, just with restaurant margins to see. That's probably more in line with what I would think. They're showing about a 7%, 8% actually net profit margin, which is what I would like to see from Portillo's or Cheesecake Factory. Oh, thank you. Great hair. Well, I got it cut while we were out of town. Um, And let's take a look while I have it in front of me about my favorite company that I constantly joke about, which is Target. because this will give me an opportunity to show you guys with the numbers of a little bit why I, you know, harp on Target. And it's not just Target. There are a lot of companies right now that are just out of favor. Nobody cares about, so their valuations seem really reasonable to me. And again, when I think about it, the ones that are like overpriced, quote unquote, I really do think it has a lot to do with the new ETFs. So I don't know that I see that changing. If we had a stock market correction, I think you'd have the same problem to the downside while they got overvalued to the upside. If people start selling those 2 times ETFs and 3 times ETFs, it's going to accelerate the down move as well. So those would be the things that would get beat up the most. I really do worry about like a Tesla. I don't love Costco where it's valued either, and I love Costco, and same with like I understand when I say negative about understand, like you're really all that concerned. When I say negative about Tesla, I love the company. We have 2 Teslas. That's all we have in our garage. So I think they have a great car. I got no issue with them running their company. I just think the valuation of the stock just doesn't make sense. It's so absurd. Um, so let me rattle about why I really love Target. So first of all, they're paying a 4.79 dividend. And this is as of yesterday because they don't update it until the day closes. Stock's down a little bit today, so it's actually going to be a little bit better. Um, Using a payout ratio of 55% of their cash flow. So that's the first thing I really love. That everybody who badmouths Target and they suck and they woke and they're going to be out of business. But first of all, they make a lot of money. So it would take a long time for that to change. Second of all, they're only using 55% of their free cash flow to pay a dividend that's close to 5%. So that covers an awful lot of not great years and dwindling sales and all sorts of mistakes to still be able to pay out a 5% ish dividend. So that is my comfort and what I love about Target, because as somebody who's somewhat old, looking closer to retirement, if I could kind of rely on something that I thought could give me 5% return without having to pay attention to the stock price and it going up or down, that's really nice to me. Now, maybe not for everybody, but using only 55% of your free cash flow to pay out that big of a dividend is unbelievably strong to me. So these other ratios, I'm not so like I can read the notes on what it is, the quick ratio, current ratio. If anybody wants to know what they are for Target, I'm happy to share them. I'd have to dig into what some of them mean. But earnings per share, $8.24. And the stock is trading under $100 a share. I'm sure, did I say, I mean, does it give me on this page just so I don't have to? Yeah, the price to earnings of 11.55. So they make plenty of money. The PE ratio is really cheap, and they're using such little of their profits to pay out that dividend. It gives room for them to do some advertising, do some growth, do some other things with the other cash, and cover their ass if things slow down to still be able to pay out that dividend, which I'm guessing a lot of investors care about. The PE ratio in their little notes is lower than 92% of the companies in the discount store industry. I mean, let's talk Target, Costco, um, Walmart. In terms of an actual company, if I ignored all of this, I would say Costco's my favorite, Walmart's my second, and Target the last. If I add in valuation in the numbers, it's the reverse. Target to me is the most attractive because they're just so cheap in terms of how much money they're bringing in. Then Walmart because I think they're expensive, and then I shudder when I look at Costco. So it's like I'd like to own Costco, and similar to whoever said it about they felt like they missed it with Cheesecake Factory, I feel like I missed the opportunity. I mean, my price point on Costco is somewhere around $450 a share, and I just don't think it's ever getting there. So I just won't own it. Return on assets 6.35%. Return on equity 25%. That's pretty good. Return on investment capital almost 10%. So again, those are all the things as to why I like Target and ramble about it so much and get into it. Is I just see them as a company that does just fine, makes a good amount of money, and they're just super out of favor. And really, I think there are tons of companies like that right now. I think there's a good opportunity, despite the analysts talking about how expensive everything is. The funny thing is, I think 2026 is going to be a really good year. I see a lot of people talking about, even Tom Lee was talking about some big correction coming at the beginning of the year and then it catching itself and ending up okay. I find when people are on the same page that they're wrong. Yeah, I hate to be such a counterintuitive, always arguing, always taking the other side, but I find especially in markets, it ends up being a good thing, and you want to think the opposite of everybody else. Well, I see a lot of people talking about this 2026 correction that's coming, which makes me think that 2026 is going to be a phenomenal year. Um, Rudolph, let me look at Vici for you. Um, what's my opinion on Vici? How often do you gamble in the casino? I gamble pretty close to zero. Um, when the funny thing is, when we moved out here was partially because I was playing poker and I was pretty successful at it. But I found either I've gotten older and I'm more risk averse, or the game has gotten tougher because I feel like even the bad players, when I sit down, like they're pretty knowledgeable, and it's hard. Like there's less of an edge. But I haven't even played poker in a few years, and I try to tell myself to go down once in a while and look at it a little differently and just go for fun instead of. But but yeah, I rarely we go to the casinos often enough to go to dinner, and we used to go to see shows and things like that. But at this point, we rarely go unless we're going out to dinner. Um, but I do think Vici is a good investment. I also I'll go over the numbers as well. I also think that this Vegas is so slow narrative that's going on in YouTube is highly over exaggerated. Because the casinos are pretty busy. I imagine they're a little bit slower and whatever else, but that doesn't mean they're not going to pay their rent. And they have these contracts with with Vici where they're not going to. I just don't see them defaulting. Like I, I don't know. Maybe I do. And no, I mean I know they talk about it on YouTube. I see the follow up only for tourists. Then I, I think it's more a narrative than anything else. My I was really shocked. So I had to run to Home Depot yesterday, and it looked like a ghost town. And I said to my wife, I'm like, oh my God, I can't believe a couple days before Christmas and it's this empty. I don't, it made no sense to me. And it still doesn't. My wife's like, well, all of our friends are out of town. I'm thinking, yeah, but they're not huge Home Depot people. And during the holidays, I'm sure there's a lot of people buying a drill or a wrench or whatever for their spouse for the holidays. So I was really surprised by that. Well, she had to meet a couple of friends and they were near the mall and she was just like, "Oh my god, it is mobbed." So I think that it's more a perception, and I think the different casinos are focusing on different things. Meaning, if you're looking at the Wynn or the Encore or Bellagio or some of the high end ones, I think that they've started focusing on the super high end billionaire client because they recognize they make more off of having a few of them and getting better margins than really appealing to the masses. If you then reverse and go to like I don't know how well people know Vegas, but the Orleans or some of the other ones that are not as fancy, they're still busy, and they have a lot of people in there, but they focus on different clients. So I think that this whole sales pitch or whatever you want to call it that I've seen on YouTube about, Vegas is dying, I don't think it's really accurate. I'm sure that we're down a little bit, but I'm also sure that when the conventions come in at the beginning of the year, that CES is going to be busy, and so will all of the others, and that it's not just like most things. I think that news is news, and they sell what people tune into. So the narrative of Vegas is dead is what people watch. Um, so let's take a look at Vici. So first of all, they're paying almost a 6.5% dividend, which old guy getting closer to retirement, 6.5%. I'm thrilled with that. If I could buy a company like Vici and they could afford to make those payments, I could care less where the stock goes. Now, my buddy and Steve and I debate this all the time. So, where's Vici trading? Let me take before. So, $27, $28 a share. So, if I bought Vici today at $28 a share and it dropped to 20, and they're still able to pay that dividend, I don't care. My buddy Steve is like, "You're a moron. If it drops to 20, you've lost your equity." Blah blah. He's right. I don't disagree. It's just two different perceptions. If I bought it and they're in the position to be able to pay that dividend and it's enough to pay the bills that I wanted it to pay, what's the difference to me personally if the equity value is dropped or gone up or whatever? I really don't think of it much more on any other level than am I still getting my dividend checks? And I hope they're in the position to raise them. Now, if they're still able to pay that dividend and raise them, odds are it hasn't fallen to $20 a share. It's just one of those discussions he and I have going back and forth on it. But as long as the inflation is still 3% ish, if I'm getting a 6.5% return on investment, like to me, that's amazing. Um, Earnings per share 2.628, sales, whatever, dividend. Um, Operating ratios, valuation, 10 time PE seems really reasonable. Price to sales, price to books. Um, but, so it looks like they had trouble in their latest fiscal year. That's why the PE is where it is. I don't know. It looks fine to me. Gross margins are good. Net profit looks out of this world, but maybe something's off on some of that. I like the REITs right now. I think the only risk is real estate. But what I found super interesting about commercial real estate is I think that all the information we were hearing years ago was true. Like the math didn't make sense. You saw rates go from 1 or 2% up to 7 or 8 for commercial real estate. And the way that they do their loans is what's called a debt servicing type of loan. It has nothing to do with anything other than how much rent is coming in versus what the payment is. So when the interest rates went significantly higher, a lot of them couldn't refinance. So a friend of a friend knows a guy who owned a bunch of commercial real estate, and when the prices went up a ton, he sold all but 1 or 2 of his buildings. And super wealthy, super not concerned about them. But the new ones hit the scenario that was a problem. So he goes into the bank when it was time because the loans are usually short term, like 5 years, and then they typically just refinance them. Well, that works out great when interest rates are falling because what's the difference when the way that the loan works is as long as enough rent is coming in that pays the mortgage, you qualify and you refinance. Well, if rates are dropping, obviously, then you can continue to refinance and it generally continues to work better and better. And the way most of these guys do it is they then borrow against it to push your loan to value down and actually use that to buy more properties. Well, that works phenomenal in an environment where rates are going lower. Well, when rates reversed, and as I think you guys know, they reversed rather quickly, all of these buildings were not refinanceable. And since everybody borrowed the money that the valuations went to, it wasn't like they have a ton of equity in them. Now, the commercial loans are what are called non-recourse loans, meaning you can't go after the individuals. Like if they lose the building, they lose the building. This was a major, major, major concern because all of these big boys, all of the Vicis and O's and everybody else could just drop those buildings onto the banks. And interest rates had gone higher, their loans sucked. This is a real problem. Well, the reason I kind of randomly talk about the friend of a friend who had some properties, so he goes in to refinance the properties. Now, remember, he sold a bunch of them. He's made a ton of money. It's a non recourse loan, and he's pretty much retired at this point. Well, he goes into the bank, they start running the numbers, and the bank says to him, we can't refinance them. The rents don't make sense for what the payment would be. And he's like, okay, so what do you want to do? And they're like, well, you're going to have to put more money down. He's like, look, you have the properties. I don't really want to put more money down. I'm looking to retire. If you can't refinance them and they don't qualify, it's fine. Just take the properties. And the bank kind of, or whoever he's talking to, looks at him and they're like, well, no, we don't want the properties. And he's like, okay, then let's do the refinance. And the bank's like, yeah, but they don't qualify. And as somebody who does mortgages, not, please don't reach out to me. I just do this stuff because I like to talk markets, not because of that. I understand how they work, and the bank is right. Like, they don't qualify. They can't just do the mortgage. So he's looking at them confused, and they're like, but we can't do them. So finally, in the end, the bank just pushes the keys back, and they're like, I guess just keep making the same payment you have been, and we'll figure it out in time. So he's in limbo. He doesn't care. He's happy to give the bank the properties. He's probably refinanced them and taken a ton of money out over the years. They're non-recourse loans, so they can't come after him personally for the upside down loss. And the bank's saying we can't refinance. That's been going on for years now, and I'm guessing that's been going on with a lot of them. That they're kind of in this limbo of making payments that are below market value. The banks are just kind of looking the other way because they don't want to own the properties because they know there's trillions of dollars in commercial properties that these guys all own. I'm sure they're squeezing the shit out of some random guy who owns one property or two properties and they actually care. But anybody who's larger and significant, the banks just don't want them and don't know what to do because they don't qualify to refinance. In the meantime, commercial real estate never crashed because the banks are accepting these lower than market payments and letting them chug along, accepting the rents that they're getting so they still net cash flow. They're kind of stuck where it makes it harder to sell the properties because some new investor would have to qualify for the loans. So either they'd have to put more down or figure something out to make the math work properly for those types of loans. But I don't see any big crash coming in the commercial space either because of what the government's allowing the banks to be able to do with these guys to just help them limp along while the math doesn't make sense and they can't refinance. And like I said, that's been going on for years. I gotta imagine a company as big as Vici or Realty Income or the others are in similar positions where they're not ready to put down another X million dollars on each property so the math makes sense, and the bank isn't ready to take the properties over because that's not the business they're in. So if the loans used to be at 2% or 3%, they're probably still making below market payments until the math makes better sense. And I think that just continues. So I like the REITs. I think that they're okay. I do worry that there could be a day of reckoning, but the fact that it hasn't yet and rates went up, I don't know, 5 years ago, tells me it's not going to. So Joe, you can even buy long-term SCHW puts as a hedge against your. Yeah, yeah, yeah. Yeah, I like options in general. I like both short term and long term. The only thing I don't like are the gurus and the salespeople. I call them salespeople on YouTube, talking about how some of this stuff is free money and just buying leaps on these companies. And I'll explain why. Because first of all, I even think half of the people talking about it don't even understand what they're saying to do. Basically, they're saying, why would you buy Amazon when you can buy a leap and put up half the money or whatever the amount is to have it for the next couple years. Well, the real reason is you're using leverage, and maybe you realize it, maybe you don't. And it's okay to use leverage. I have no issue with using it. I have an issue with some YouTube moron telling people to use leverage that may not even realize they're using leverage. Like, they're just thinking, I can buy twice as many shares of Amazon using leaps instead of the cash that I would have to put up to buy Amazon, with no recognition that, no, you've done nothing different than just leveraging your account, and that options have unique portions to it that are separate than owning the stock itself. So options are comprised of what one would call different quote unquote Greeks. The stock itself is just the delta. It's just owning 100% delta and nothing else. And if you bought leaps instead of a stock, you then own time decay and volatility and the other portions that go into an option that are actually more important than the deltas themselves. So, so no, Jacob, you can come in and grab something. It's fine. Sorry, my son just sent a text asking if you could grab something. So feel free to say hello. So when you buy a leap, you're not just buying the stock. It doesn't mean you own double the stock with no more risk. And let's take the scenario, and I'll make up numbers because I don't have it in front. Well, let me open it up and put it in front of me. So let's go to Amazon, and I will show you exactly what I mean so that it's so snapshot. Let's go to, sorry, I usually work off my phone, so if it takes me a minute to find options. Okay, so Amazon right now is $2.32 a share. So let's say we go out, let's open up the strike price, and we go out to, let's see, how far will it let me go? Let's go to December 17th, 2027. So 2-year out options. And instead of paying 232, we can buy, what's this strike? An $150 call for a little more than $100 an option. So we'll go to the 155 because it's got a 99.85 offer. So I'll call that $100. So for only $10,000 instead of over $20,000, so you're putting up less than half the money, you can buy the 155 call. Well, you're already $80 in the money. So Amazon would have to fall $80 for you to be out of the money, where you would actually have a total loss and lose all your money. Now, that's number one. I don't think it's going to happen. So I don't I don't want misunderstood. Forgive the, I love Amazon. It's one of my top picks for 2026 in my mind. Maybe I'm wrong, but you do have a strike price. If I'm wrong and it's below $155, as opposed to buying 100 shares and paying your $23,000, if you buy the same amount in terms of dollars, you put up 20 grand to buy 2 calls, because now you're wielding 200 shares instead of 100. If something weird happens and they end up at $150 in 2 years and you've held it all the way, you have lost all 20 grand. Whereas if you bought 100 shares and it fell to 150, well, you've lost about $8,000. So you are risking the money differently. You do own sort of 100 shares, but again, let's do the math. You've paid $100 for the 155 call. It has to get to 255 within those 2 years for you to essentially have broken even. Again, you would have made not a lot, but 30, 40, $25 on shares if you had just bought the shares, as opposed to breaking even. Now, as it goes higher, you will own 200 shares instead of 100, so you will profit more, which is kind of the bet you're making. But every day you lose a little bit of time decay, so the value of that option gets closer and closer to true value, as opposed to having that $25 cost to be able to have the option on. And there will be a break even because again at the 255 level where you've broken even on the calls because you made the $25 premium, if you own the stock you actually made a little bit of money. So you'd have to do the math of where I actually am ahead owning the 200 shares versus it would have been the same as if I just bought 100 shares, and decide for yourselves, do you think that means that I'm better off? It is more risk. But if you don't think there's going to be a huge crash and you're okay with the higher risk, it is a way of being leveraged without putting out quite as much money, without using margin so that you don't have to actually pay interest to own more shares, to put on a larger position in the stock you love. Um, I thought it might be something I might have wanted to do with Palantir because I think it's so overvalued. I don't really want to own it. But if I bought leaps that were 2 years out and the math made sense of where it would have to get to break even to buy one leap in Palantir, if the thing just skyrockets to the moon, well, and then I know my downside risk if I spent, I don't know, $6,000, $7,000 on it. So I do see some reason to use long term options. I think Joe's comments about the long time puts, they totally protect you. I do like options a lot. I'm just hesitant out of it because I think a lot of people they get a little confused for it. And I actually love selling puts to get into positions too. Sorry, Joe, let me read. I know you're talking about some of them. We were talking about silver recently. I got to tell you, I actually love platinum. The main reason why puts on silver or hood or SoFi. Whoops, what just came up? Just plow people. Yeah, yeah. Right. They're paying they're overpaying for the protection. The more volatile a stock, the higher the price of an option that's going to be. And they end up buying the protection and it just costs them their gains anyway. I think most things like Hood, which I know Joe makes fun of me on, but understand, I mean, I got very lucky with Hood. It's just when I look at it now, I see no point in getting out of it. That was kind of the point of the trade, and it was a small enough bet originally, and it's why I put it in the account that I don't really watch. I was just screwing around with 100 shares, which um, silver lotto ticket, but silver at 64.50. So Joe does a lot of charting and graphing that I don't always pay attention to. I do think silver seems overstretched. So, and if I'm not mistaken, I think he's kind of thinking it's got a pullback, which it's very hard for me because I think silver is in an uptrend, but I also think it's overstretched. So I think it could potentially have a pullback, but some things just stay overextended and just keep going. And what I started to say is, so to give an idea of how long and how stubborn I get on some stuff, I bought platinum years ago when platinum became less expensive than gold. I thought it was the dumbest thing and made no sense. That was probably around 2000. And I think I paid anywhere from 800 to 12 or $1,400 an ounce for the platinum I was buying. Well, gold just kept going. And if I ignore the past 2 months, platinum was still 1,000 or 2,000, and I don't watch it close enough to know exactly, but it traded below 1,000 somewhat in recent history. So I've owned it 20 years plus. It has done terrible. And the ounces I've kept are really stubbornness of me scratching my head, especially because if you go to a jewelry store, they still charge a premium for platinum. Like if you bought a platinum bracelet and a gold one and nothing else different in the bracelet, the platinum one is going to be more expensive. Now that used to be the case because platinum was more expensive than gold. So it kind of cracks me up that people go into jewelry stores and don't question this stuff. Like I'm a total nerd, I'm a math guy, but most people walk into these stores and they just think, yeah, platinum's more expensive. But meanwhile, platinum went from 1,000 to 1,000, and gold went from 300 to 4,000 and change. And in the meantime, platinum bracelet is still more expensive than gold. Makes no sense to me. Now that platinum seems to really be spiking, it is such a thinly traded market. I think your downside is it goes back to 1,000, and your upside is, and I know everybody's going to think I'm nuts, it could go to 20,000 or more. Like it is an obscenely thinly traded market that I think realistically it could go to 10,000. But there is no reason it can't be double the price of gold. It is unbelievably thinly traded, which means you have a chance of 5x while you're risking to lose 50% of your money, with an outside chance of a 10x on a bet that has already moved significantly in the past few weeks. And the more that it's moved, the more bullish I get. And even if it gets extended, I think the pullbacks are going to be fast and short lived with reversals that just keep going if it keeps going. Um, Joe, well, I'm about to single handedly put an end to the gold and silver rally, especially the PM stonks. I'll spew my dust long. Yeah, I mean, they could. Look, it's the end of the year. This could be the dead high. I totally get it. I just thought gold was topped out a while ago. And in my mind, the things that I look for a true top, while people are asking about gold who don't typically ask, or silver, it isn't a mania. Like when I think about when Bitcoin made the last high, not now and not recently, and I would go to a Super Bowl party and housewives were talking about their Dogecoin and their what was the Shibu Inu. That there was one other too that like gold hasn't gotten to the point where the everyday person is just saying gold is going to the moon. And where I look for tops in terms of like a complete blow off, we're at the end, is when the the waiter or waitress or the doorman at a high rise or the Uber driver, and not one or two, but where you're just hearing real estate did it in the great financial crisis. The internet stocks did it in the dot-com bubble. That's the only thing I look for in terms of actually getting out of things that are going up or down. I wait for the point where it's a definite mania. Just about every YouTuber is now being paid by companies is a lot different than what I'm talking about. And I get it. I see more of it, which is why I say I see people talking about gold and silver and some of the other stuff more than typical. But if I went to a Super Bowl party, I don't picture everybody talking about the medals yet. That's what I'm waiting for. It's when it's gone so far that it just the fear of missing out sucks everybody in, not to where it's getting some people who aren't normally involved paying attention. I want to see the my wife's friends talking about it. I'd name names, but Once they start asking me about it, then for sure I would get out of whatever it is that I'm looking at, just because they're going to be late. And when they're asking, it's because so is the Uber driver and the doorman and the people, just everybody. And to me, that's when markets have gone too far. I don't, Joe, I don't want that to come off the wrong way, because I think if you bought gold here and you plan to hold it for the next 10 or 20 years, you won't be very happy with these purchases. I think we're already hitting that point where it's overvalued. But if I owned it, and this is not financial advice. This is just Adam's opinion, which is worth about as much as a plastic cup. So please don't use it for your decisions. Don't take it for any. It's just my thoughts, which whatever. But I don't think if you owned it for 10 or 20 years that you're going to be really happy with these purchases. But I think if you're somebody who pays attention, that you probably still have some upside before it corrects. Um, that's just my thought on it. And the spike at the end is the one that could be massive to draw people in. That's why I wouldn't want to sell here, is that end move, what I used to call on the floor, like, forgive the is the orgasm. The orgasm that I used to see at the exchange is such a push up because everybody is buying and there's no sellers. That's what I'm trying to time, and I see the beginnings of it where the money is flowing towards it, but in my brain I haven't seen that final push. But could be wrong. It's just, like I said, just my opinion. Um, there are also a lot of people who don't see this as a massive top. Yeah, yeah, and they never do. And but I'm looking for the same thing. And maybe it's so spread out this time that I'm not going to get what I was looking for, if that makes sense. Maybe since it's an everything bubble, so to speak, and that it's Bitcoin and stocks and real estate and that I won't see that massive push that I'm looking for. But it's also why I'm still bullish, is I'm still waiting for that massive push that I don't know what the catalyst will be. And I just haven't seen that yet in any of them. But again, maybe I won't because it's too diluted. I saw a great, sorry, one last thing, because we've done about an hour and it was something I wanted to talk about and forgot. But I saw a great video interview by what's his name? Graham Stephan, who I find very entertaining. He's actually here in Vegas, so I'd love to have coffee or lunch with him. But especially when he was talking real estate, completely disagreed with him for a long time, because he was one of those gloom and doomers. It's all collapsing. It's all collapsing. And I used to think he did it for views. Maybe he did. Maybe he didn't. He's unbelievably successful, but I saw a great interview with a guy he did who ended up working for Mattel and dealing in collectibles. And similarly, like, they have the same, like, markets tend to have these cycles. And anyway, if you have a chance to watch the video, I found it super interesting because he was looking at some things that I've looked at, that I love these as alternative investments, because they tend to be counter movements to the markets. When the market's correct, typically in history, collectibles don't. Um, and the one that I keep thinking about is like the original iPhone. I think is probably going to be one that'll be worth an awful lot of money if you have one in mint condition, still sealed in the original cellophane and in the box and everything else. Just because I think it's a thing of history and everything else. But I like markets, all of them. I wish I could have better. This is not sarcastic, Joe. I wish I could have better back and forth on some of the ones you talk about, but I have a limited capacity to the amount of tickers I pay attention to, and you watch a lot of different ones than I typically do, and it's I pay attention to the ones I pay attention to. And while I can take a quick glance and have an opinion, it's not going to be a very educated one because it's not something I watch consistently. Like I really would do a better job, but I know you do the research on your end. And for me to have a response when I'm not really doing the research on my end, maybe we'd agree on it. And maybe I'm just looking at it short term. Um, so, anyway, I hope everybody had a great day. I will be here next week. And if we start getting a little bit more people involved and have some more questions and stuff. Like I said, I'd like to add more days. I mean, if I could find the time, I'd do 5 days a week. I love the live. So if anybody wants me to take a quick look at another stock, by all means, feel free to cram it in and put it in the comment section. I'll take a quick look. If you haven't, I assume just do me a favor, hit the subscribe button, the like button. As much as I say that out of habit because everybody else does, I don't know. I like doing this stuff, so I don't really do it for any other reason than it gives me an outlet, and my wife doesn't want to hear me talk about stocks all day. So, but I do, I don't know. I might look at some of this other stuff. People ask me. I don't even know what Discord is. I've just heard the name and some of the others. I just don't know how much I'll commit to it, or if I find the time and start poking around on some of it. Cracker Barrel. Yeah. Unfortunately, yeah, Joe. How about Crescent sentiment is? It's funny. I suggested Cracker Barrel years ago, and I hate it now. Let me look at. I remember taking a closer look at it recently, and similar to Cheesecake Factory, part of my problem was their food was terrible. And look, I hadn't been in years. My wife and I, we started going out to Utah once every year or two, where we charged the car is attached to a Cracker Barrel. I was like, oh, let's go there because I have great memories when I was a kid. We went. We thought it was really good, so it became kind of the place we would stop when we. This was when it wasn't the dead highs at like 100 or wherever it was, but I think it was getting into like the 70s or 80s, and I looked at it and I thought, hey, this doesn't look so bad. I took a small loss and got out, and I've always kept an eye on it as I've watched it plummet. But the last earnings report, whatever the CEO said, like it was the first time I paid attention to the earnings report. I remember just being like, "Oh my God, this thing has really turned for the worse." And the last couple times when we stopped, we're like, we're not stopping there again. Like maybe we just missed it when we stopped there the first time, and I was overexcited because of the memory. But both my wife and I said the same thing. It was like overcooked, over greasy. We both felt lousy afterwards, and it was just like, forget it. And the first time I kind of thought, they should just raise their prices and this and that. But so let's see. Yeah. I found a good ice cream company. It's got this terrible labeling, and they sell it at Albertsons and Smith's here. Umpqua or something. That's a good ice cream. It's a fat guy telling you ice cream. Trust me, it's actually pretty good. And one of the better ones instead of the ones that are freezer burn and whatever at the stores, because I know exactly what you're talking about. And God forbid you let it start to defrost and put it into your freezer again. You've totally ruined it. I don't know, their PEs was lower than I thought it would be, but I thought they were taking losses and everything else. Let me look at the fundamentals real quick and let me see. So their net profit margin is 0.49%. So maybe that's short term. Their gross margin 68, but they got to clean something out. And I remember being really disappointed with some of it. And here's the other problem. So they're paying a 3.84% dividend, which they had to cut massively because they couldn't afford where it was previously. And their payout ratio is still 133%. So they've got some real problems. If they're making less than 1% in a net revenue, paying out 133% of free cash flow, I don't see it improving unless some things really turn around. Down here in Florida, yeah, Publix. I know Publix. Yeah, I love Publix too when we've gone to Florida. They're a good supermarket for sure. Anyway, I didn't love Cracker Barrel. I'm gonna head out because I'm gonna go spend some time with the family as we get into the holidays. I promised Grandma and Grandpa are visiting, and I promised we'd get my son and we'd play some Uno and do some other stuff. And I'm gonna watch the last hour trading. Have a great day. I'll probably start posting videos again, and then we'll see what else happens. Thanks so much, everybody.